Hello, everyone, and welcome to the fifth part of the webinar series on using technical analysis from a trader's perspective. This is your host, Prasenjit Biswas, and so far we have covered quite a lot of topics in the preceding four webinars, and we have talked about how to identify trades using trend lines and patterns, actionable ideas. Then we also looked into using some of the indicators like RSI and volume as a filter to identify trades, and exactly how you can use them to improve your performance. And then in the last webinar, we also talked about reading markets, which is very critical in terms of understanding the environment, as this would also help you to understand when you need to swing your bat and when you need to keep quiet. So today I will be talking about the challenges that one would face when it comes to real trading, because from the practitioners perspective, there are a lot of issues that you might face, which which comes up when it comes to practical trading, when there is a real money that you are putting into the game. So we will look into all of that, and we will try to understand what can go wrong and how to deal with those situations that you are likely to face if you are going for a real trade in your career. So the challenge that one generally comes across is firstly the fact that there has to be some mechanism or method to find out trades consistently over a period of time again and again, and keep doing it every single day. So that is one of the challenges that people face, and at times it really becomes difficult as well, because while you're trading for yourself and looking at the market every day does take a lot of toll on your psychological bent as well. Second is the fact that markets being quite unpredictable, and they are by default unpredictable in nature. So when a trade goes wrong, you feel dished by the market, and you feel that things are not going to go as per your plan, and you lose your confidence, and you even lose your faith on your abilities. So these are the things that actually happen to a lot of traders that I have seen, and of course that would add to your mental stress. So all of it makes the whole thing slightly more difficult especially for the newcomers. And then once there is a question mark in your mind regarding your tools and methods, then you look for improving your method, and maybe you look for some better tool that you think that there exists in the market, and you maybe try to seek help from experts and gurus, and then you also try to hunt for some kind of a software which can probably give you trading signals and maybe make your life easier. So these are the things that really people come across, and these are the things that I would say that I have seen facing a challenge in reality. So broadly, if you ask me, all these problems can be segregated into three categories, and that would be the three M's. That is the root of all problems in terms of the method, the me, and the mind. So when it comes to method, what do I mean by that is, it is important to have a method which works. So it is important that you master one particular technique, and you have faith on that particular method, and you really understand that method. So the idea is that there are so many methods in the market, right? So there are so many tools in the technical arsenal. But the idea is not to learn, not to just know each of the methods, but what is important is to have a mastery on at least one particular method where you are probably in the top notch, you're in the top percentile when it comes to that particular method, because that is what will give you that edge. The second thing is that it is important for you also to understand the horizon that you are comfortable with. Say, for example, there are people who are comfortable trading on a slightly longer term horizon, like holding a stock for about a month or a couple of months. And then there are other people who are purely intraday traders. They do not quite feel comfortable when it comes to holding for 2 months. Like there is a friend of mine who does only Bank Nifty intraday trading, and he does pretty well. And if you look at me, I have to talk about myself. I am in between. I do not do intraday, and I do not recommend the intraday trades much. But then what I do is kind of a momentum trade for about a week's time. So that's what I do. So it is also important for you to understand what time scale you are comfortable. And then it is also important to understand what kind of asset class you want to trade. So based on your method, I mean, you can say that technical analysis works on every asset class. That is true. But then what you are comfortable with trading and what you understand better and what actually fits your method well is also important, because there are certain asset classes which are trending in nature and which are very long range trending. And then there are certain assets which are not which do not have a very long range trends. So something like a currency will not have a very long range trend. It will never happen that maybe your ISD rupee USD will go to some 500 rupees and then 1,000 rupees. So it cannot just keep on going up and up. So there is a specific behavior related to the asset classes as well. And then it is also important to understand the profile of your method in terms of the risk reward, the strike rate that it has, and then how many trades you would get, the frequency, if I have to talk about, like how many trades you are going to expect during a month or maybe in a day if you're doing a day trade. So how many trades do you expect to get based on your method? So these are the things which are important. And then in terms of the specific risk profiling, like the run-off losses and the drawdowns that is you are going to see and that is likely to come. So that is what will help you to kind of have the right kind of leverage and have the right kind of capital deployment as well. And finally, of course, the understanding of the return is very important, like what kind of return you are going to you should be expecting for your method on a annualized basis. So these are the certain things that you have to keep in mind. And probably the method that we discussed in the previous webinars, which is based on trend lines and your patterns, do have a reasonable degree of accuracy. And of course, you need to practice harder, and only sufficient amount of time is given, then only you can achieve that much of confidence. You will get that confidence in your method. So the other thing that is important is the aspects of money management. So this is the least understood and probably one of the important things, in my opinion, that is not really taken care of by most of the people who are new to the market. So if you're like thinking of your own proprietary trading or personal trading, then this is what is very important, I would say, for you to really understand. So there is a saying in the market that discipline is very important and one must maintain discipline. And if your stop losses are triggered, then you got to exit. And if you have your targets in your mind, and until your targets are achieved, you also got to hold for your trades. So the point is that how exactly do you do that? I mean, it is not that easy that if your stop losses are triggered and you can like simply exit and come back to the market again with the same aggression and confidence. So it does not really happen that. So it takes a lot of practice, and there are certain things that needs to be taken care of before you can actually maintain the discipline. So we will look into all those things. So the point is that how it goes is basically, if you ignore the position sizing, then that actually leads to an oversized positions. And when the price goes against you, then what you encounter is a loss which is larger than your expectation, and that's where everything the problem arises, and that is where people find it very difficult to to deal with and take the losses. So the moment you have a loss which is kind of more than your expectation, let's say if I would have approached the market with the mindset that I can risk say about 10,000 rupees for a particular trade, and then because of the position sizing, if I see that by the time my stop loss is reached, I am at a loss of about 25 to 30,000. So if I was thinking for a 10,000 rupees loss, now I have a 25,000 rupees loss. So it is pretty big in comparison to what I had in my mind. So emotionally, it is very difficult for anyone to accept such kind of a loss, and that's where people compromise on their stop losses and targets. And what eventually leads to is the disaster. So the key takeaway is that always have the position sizing in mind, and you got to take the right sized positions. Not to say that leveraging is bad, but then you must know what is the right leverage that is suitable for you. For example, if you're doing a futures trade, then probably exchange would charge about 25 to 30% on your future position, so which is like a 3x leverage. But then that is a minimum requirement from the exchange standpoint. Now, if you have an understanding of your run-off losses and the amount of risk that you are likely to see for a given trade, let's say if I am keeping a stop loss of about 5% on any given trade, and then say if I have a position of about say about 10 lakhs, which is like one lot, say it is of the size of a 10 lakhs total volume, then I would be actually risking about 50,000 for that trade. So now what this means is that for a position of 10 lakh, exchange would be charging somewhere around 2.5 lakh to about 3 lakh rupees. Now, if I only had say about 4 lakh rupees in my account, and then if I'm taking such positions, then it is quite possible that if two trades go wrong, then I won't have enough capital in my account to take the third trade or the fourth trade. So that's what is important for you to understand, like how much runoff losses can your strategy absorb, and how much should be the leverage in that case. So if I have a 5% stop loss generally, and if I can have a runoff, say about 3 to 4 trades which can go into a loss, so that means for every trade, if I take say about 5 lakh rupees position, then if one trade goes wrong, then I'm going to lose about 25,000 rupees. And let's say if I have a loss of 4 consecutive losses of 25,000 each, then I would end up into a total loss of about 1 lakh rupees. So that would mean that if I have to take positions in certain futures, then I must at least have something more than 1 lakh or about 1.5 lakh extra above what the exchange would be charging. So if exchange is charging me 3 lakh rupees for a trade, or 3.5 lakh rupees for any trade, then I must keep about say 5 lakh rupees into my account. So this will keep the necessary capital that is required to take the next trade. And this is probably also important from a psychological standpoint. So position sizing is what needs to be worked on. And then the next question is that why stop losses are important. Like if you say that stop losses are important, then of course you would also argue that there are certain cases where you have seen that trade goes and hits your stop loss, and then again it would come back. So I myself am saying that yes, it does happen that you put a stop loss, it might get triggered and then again come back. It doesn't matter. I mean, no trader has ever done any trade without taking a loss. So the point is that if you did not maintain the stop loss, then maybe out of the 100 trades that you are taking, so let's say about 30% of the trades go wrong. So these are the losing ones. So if you do not maintain any stop losses here, then what will happen is that probably 27 trades out of 30 would again come back to your, your buying price. So you would feel that all these 27 trades that you actually took the loss are were all needless. So that is true. I mean, apparently it looks like that, but then the question is that what about the rest of the 3 trades? So it is true that in 27 out of 30, you might have recovered your losses even if you would not have kept your stop losses. But then the rest of the 3 trades are like, they are like atom bombs. So they can completely destroy your portfolio, and you don't need 3 atom bombs. You need only 1 atom bomb to destroy your portfolio. So this could be a DHFL, it could be a Yes Bank at 400. It could be some JP Associate. It could be some Suzlon. So it could have been any stock, which could have really taken you down. And that is the reason that we need to take losses, even if it seems unnecessary at times. So that is what always will keep you in the game. Just remember one thing, that trading stock markets are like, it's like a never-ending process, and it is like a war that is going on. So if you have to win the war, then you have to be alive. You cannot just afford to die and you lose the battle altogether. So that's what is important, that you have to be in the game to win the game. So therefore, I would say that it is better that you take small losses, which can be recovered in the next trade or maybe in the next 2 trades. But then if you do not take those apparently unnecessary losses, then you might someday hit upon a trade and which can completely take you down. Now, the next point is regarding the psychological game, the mindset, which is again very important. So in my initial days when I joined the industry, I felt that knowing how to pick stocks was everything. But then over a period of time, after 15 years of experience in this industry, I realized that probably method is only 20%, and the risk management and the emotional control is actually 80%. In fact, that is what differentiates one trader from another trader. So there are certain unique qualities or certain traits that some percentage of the successful traders have, and to me, it is the psychological aspect. So the whole point is that how do you really achieve the right mindset that is required for a trader, to be a successful trader. So the first thing that one needs to do is define your risk amount, which I've already discussed. So that is very important, that you must have a very clear risk amount in mind. And when you go for a trade, let's say if you're taking a 10,000 rupees kind of risk for a given trade, my suggestion is that do a dry run in your mind. Do a psychological kind of a tuning to your mind, that you have already taken the loss, and write off the loss in your mind. So that actually will help you very much, because when the situation would arise, if in case if your stop losses are triggered, then in case if you actually have to take that 10,000 rupees loss, you will be able to do it very easily, because you have already done that dry run in your mind. So then there is a concept of time as a stop loss that I use. So in case if a trade that you feel is not working out, or it is likely to fail, and it is not going to respond according to your initial observation or your initial analysis, then it is better that you let go that trade. Don't wait for the stop loss to actually get triggered. So if you can save 1 or 2% in losing trade, so that is the money that you make actually. So it is every penny saved is a penny gained. So the point is that if you feel that a trade is not going in your favor, just come out of it. So I myself do it like that. I mean, I don't. If a trade has like a 5-day horizon in my mind, and if I see that nothing is happening to that trade in the next say 2 or 3 days after taking the trade, and if I feel that there is lack of momentum in the trade, I prefer to come out at cost, or maybe marginally at a loss, or maybe marginally in profit.
So, that's what keeps me psychologically, unbiased in the game. So just remember one thing, that the longer you hold a trade in the market, then what happens is the influence of the market on the stock becomes more than the inherent, setup of the stock itself. So the more longer horizon you're holding the trade, the more influence of the market that is going to impact the movement of the stock. So use time as a stop loss. I think you will eventually understand what I'm trying to say. I mean, it will be probably it will help you. Then think of every trade as a probability. So the moment you think that a trade is just a probability and it can either go right or it can go wrong, then you are again emotionally detached from the trade. So that's what will keep you kind of emotionally balanced. So be open to the fact that it can go wrong, and just remember one thing: to make money, you don't have to be correct always. And just remember this, it will be all fine with you. So let the mathematics play out, and let the probability numbers play out for you. So if you feel that if your method has a strike rate of about 65%, then just don't bother about this particular trade. It can be amongst those 1/3 of the trades which go wrong, or it could be amongst the 2/3 of the trades which go right. So you don't have to worry about which way it is going to be. You just take the trade, and that should be it. Third is like there is always a gap between thinking and executing. So the big difference between thinking what will happen and really executing the trade is what I call as a psychological gap. And when you see an opportunity which satisfies your criteria or conditions, just go for it. Don't have to be bothered about whether it will go right or whether it will go wrong, or don't worry about the outcome, right? So this is what is generally I have seen, that a lot of people who are good in analysis, but they are not somehow able to convert their knowledge into money. So probably that's where the issue is with them. So they are able to analyze, they are able to visualize what will happen, but then they do not have that guts, I would say, if I have to use this word, to really go for it. Yeah. So just swing the bat. Don't have to worry about whether it will be a 6 or you will be out. So it's okay if you're getting out, come back in the next match and you can still score 100. So that should be the mindset, that you've got to take the opportunities, because if you do not take the opportunities, then that is probably the biggest risk you're taking, as it is said in the market. Then the fourth point is booking losses versus accepting losses. So what do I mean here is that, let's say if I take a trade, and if my stop losses are triggered, then I would actually take the loss, come out of the trade. But then does it mean that I have accepted the loss? Not necessarily, because taking a loss is something and accepting loss is different. Booking losses are like you might have booked the loss, but you're not able to reconcile with it. And accepting on the other side would mean that you do not have any psychological baggage regarding that loss. You are in absolute in synchronization with what happened to the previous trade, and you do not have any grudge or any regret regarding the trade, or you do not have any kind of negative kind of emotional thing going on in your mind, which is holding you from taking the next trade. So accepting loss is very important, that you reconcile with your losses, and you do not have any kind of baggage which will influence the next trade. So a lot of people, what they do is that if they have probably suffered a loss in the previous trade, then they think twice before taking the next trade. So I mean, that's how markets work, but then that's what is the biasness that you have to get rid of. So your next trade should be absolutely independent of what happened to you in the previous trade. It does not matter if you had made some 20% profit in the previous trade, or maybe a 2% loss or a 5% loss in the previous trade. What is important is to understand what is the right thing to do at the moment regarding the positions that you are holding. So if your previous trades are dictating what you will be doing next, then that's what is something which is going to be detrimental to your performance. So try to disconnect what happened to you previously, and try to do the right thing that is justified in terms of your that the knowledge you have, and should be the right thing to be done at the regarding the merit of the stock that you are holding. So again, I mean, so this is where the position sizing will come into play. And if you would have taken a loss, which is okay with you, let's say if you had a 10,000 figure in your mind, and maybe if you would have taken a 8,000 loss or maybe a 12,000 loss, then still you are in the game. You do not have any baggage regarding it, because you know that this 10,000 loss can be recovered in the next trade. So it's like taking singles. So if you have to score a century in a test match, then it's not the sixes that you hit. You look for scoring singles and make sure that you do not lose your wicket, right? So that's how the thing is, that try to reconcile with your losses and just move ahead. And then like try to accept if you have done any mistake, or if there is anything that is lacking in your understanding, or because of which you would have lost money. And try to take the responsibility on your own, because if you try to blame the market or somebody else, then the problem will always remain because if you think that it is because of the market for which you have lost the money, like in case that you were long on a particular stock, and if there was a negative news overnight, and because of which the stock just gapped down, then it is something which is inevitable, and it can always happen. That's where your money management and everything comes into picture, where you not lose an amount which you cannot recover. So if you understand this and accept this, then basically you will feel that it is nothing to do with the market. It is just that it is the way things are. And at the same point of time, if you think of it that if things can gap down against you, then it can also open in a gap up in your favor. So over a longer period of time, at times something will go against you out of your calculation, and then there would be something which will probably give you more reward than you would have expected. So in the long run, believe me that these things balance out. So all these things are like evened out. So the point is that there is nothing to really be afraid of or to really fear. And if you accept the responsibilities, then I mean, markets won't be looking like something to beat or something to compete with, or like an enemy. So the takeaway for this session, I would say that it is important for you to know your personality, what kind of trader or investor you are, what is the time scale that you are comfortable, and what type of trades you are comfortable. Like we discussed about momentum trading. So if you're doing momentum trading on an intraday basis, if you have that time and the infrastructure to do so, then you can do that. And if you feel that you do not have that much of time and you have other obligations and commitments, then probably if you think that something like a positional or a medium to long term trades work for you, then go for it. I mean, technical analysis is not about intraday trading. So there is a misconception regarding that, but I hope that all of you are probably aware that technical analysis can be used from about 20 minutes to about 20 years time scale. So it is important for you to know what is the range that you are comfortable. Second, like as I said, that have a systematic approach. Every trade that you are taking should be justified by some rational or some reason. It should not be that you are taking trades at random. Let's say if your process is not, it need not be absolutely mechanical in nature, but then it has to be based on certain logical, rational, and certain rules, which are like which you can replicate. So basically, the idea is that if you have a systematic approach, then you can probably test your ideas. You can backtest your ideas, and you will be able to replicate your performance. So it won't be like kind of a luck factor thing. And then always have a realistic goal for yourself. Like if you think that making say 20% a month is possible, and if your method is showing that much of giving you that much of confidence, or if the results are showing that it is possible, then there is nothing wrong in setting up a 20% written goal for a month. But then if your method is not like for a high frequency kind of a trade, then it has to be like a reasonable thing that you think you can achieve over a period of time, and you can repeat it time and again. So have a realistic goal for yourself. Then don't be bothered about if your friend is making 10% a month, and if you're making 5% a month. So everything will fall into place if you follow your methods consistently. The point is that who makes 5% this month is not important, or 10% this month is not important. What is important is that who has made consistently money for the next 10 or 15 years. So even if you're making 10% a month, and if you can do that for the next 10 years, I think you are going to be at the top. So the point here is that the performance has to be consistent, rather than something which looks very attractive in the short term. So again, the next point is pay attention to your capital allocation and risk limits. So as I said, like for every trade, you must be aware of how much money you are going to risk, and probably do a dry run in your mind before you actually take the trade. So that will help you to deal with any negative outcome in case the trade presents with. And also avoid this revenge trading. There is there are certain people whom I have seen that if they suffer a loss, or if a trade goes wrong, then they immediately try to recover that loss. So just remember that thing, that if you have taken a loss, it is not the problem of the market. It is your problem that you have had to take that loss. So you can only recover that loss when market gives you the right opportunity. So if market is not giving you the opportunity, so just relax, and surely it will give you when the time comes. So if you try to do something which is not normal to you, or if you just try to experiment something new, then maybe it may not work for you, and it can actually go drastically wrong against you as well. So trying to recover losses is what you should be thinking of also, but then it should not be like an immediate thing. If you feel that there is an opportunity in the market immediately to recover the losses, then just go for it. But if you feel that there is nothing in the market really at the moment to take a trade, but still the loss is there, so be it. Wait for a couple of days, and I'm sure that you will get the right opportunity where you can not only recover the losses, but you can actually make double of what you would have lost. And then finally, just remember these words, that you don't have to be correct always to make money, right? So it's just a game of probability. Just let the probability number play out its magic. So with this, I come to the end of this webinar today, and just I would like to mention a few thoughts to the people who are for long-term investors, that Rome was not built in a day. So this is a saying that we all know. But to the traders, I would say that it is also the fact that Hiroshima was destroyed in a day. So with this, I come to the end of today's presentation, and I hope that you actually enjoyed, or I was able to share something which probably added to added value to your existing knowledge over the last 5 webinars. And thank you so much. And signing off, this is your host Prasenjit Biswas. All the best for your future trading career. Thank you.